Okay. Well, hello and good afternoon, everyone. My name is John Servos, and I'm the Director of Commercialization Education at Fast Forward Medical Innovation, also known as FFMI, and I want to welcome you to today's webinar. Before I introduce our speaker, though, I do have a few things I'd like to cover, including some technical housekeeping items. Please keep your microphone and video muted throughout the webinar to cut down on any background noise and distraction. If you would like to ask a question today, please type that in the chat feature. If you don't want to type your question, you can also submit an X to indicate that you would like to unmute your microphone and ask the question directly. I, as well as other FFMI team members, will be monitoring the chat function, and we will address questions periodically if pressing, and then again at the end of the presentation for an open Q&A. Just a reminder that this presentation is being recorded, and we will share a version of the recording and the slides with you. Today's webinar is titled The University Exit and Extramural Funding, and it is intended to provide a closer look at venture capital and other forms of funding for startup companies. It's provided by Fast Forward Medical Innovation, which is a unit of the University of Michigan Medical School Office of Research, where we help biomedical researchers accelerate innovations from idea to impact. There are 4 functions to FFMI. We provide education, such as this webinar, and additional courses to teach commercialization concepts. We have multiple funding opportunities that come with mentorship. We have a business development team that connects investigators with company partners, and then we provide all of these services to a state and nationwide network as part of a hub. Today's webinar is the 6th of 7 that we are offering and have offered as part of a series. Broadly, the goal of that series is to outline and describe critical concepts related to commercialization, analyze unique paths to market, and appraise different models of academic and industry collaboration. You can see a full lineup and all of the recordings of the webinars on our website. And I'll note that the final webinar is scheduled for Wednesday, September 2nd, and that will focus on industry and academic partnerships. The final note from me is that the next FFMI Innovation Studio will be offered on September 15th, and spots are still available. This program is similar to office hours for innovators who are working on a project. However, we enhance the experience by having you register in advance with a description of your innovation and some preliminary questions. That information then allows us to invite the appropriate experts from our network to give you the best advice. More information can be found on our website. So with that, I'm going to introduce to you Harak Parikh, who is a Michigan Biomedical Venture Fund Manager with both FFMI and the Center for Entrepreneurship at the College of Engineering. Harak, as I mentioned, is the Program Manager for the Michigan Biomedical Venture Fund, which is a seed fund that provides early stage capital to the University of Michigan biomedical startup companies to successfully commercialize their research. Prior to joining the fund, Harak was a Principal Scientist and Director of U.S. Operations for Neuromarketing Labs, which is a startup based in Germany. His previous background is in neuroscience research and product development. Harak received his PhD in biomedical engineering and a master's in science degree in electrical engineering from the University of Michigan. So thank you so much for joining us today, Harak. I'm going to turn things now over to you.
Thanks, John, and welcome to everybody who's taking time on a beautiful summer afternoon to come listen to me and listen to the talk on extramural funding and venture capital. So as John mentioned, I got my degree at the University of Michigan Medical Engineering, and I've been running the fund. I came back to the university in 2016 to be the program manager for the Michigan Biomedical Venture Fund, and through that, we have funded 10 investments. We did have one exit earlier this year that I'll talk about later in the presentation. And basically, my whole background has been working at startups since I graduated, and now I am evaluating startups. So the topic of today's webinar is how do you get extramural funding? I know that those of you who attended the series last time, Sarah and Michelle covered a number of opportunities or ways you can get your startup funded within the university. So today's focus is sort of externally facing, and we don't have time to cover every detail. This is just intended to be sort of a list of resources and funding sources that you can look at, and we'll spend a little bit of time on what venture capital is, what venture capitalists look for, how, when are you ready for that? When are you not ready for that? Things like that. So in terms of questions, if you have a question, feel free to jump in, and I'll try to give a quick answer then. But if it's a longer question, then we'll wait till the end of the question answer to do it. So, so let's get started. So I'm sure some of you have seen these slides before. What we are trying to do at Fast Forward Medical Innovation and broadly at the university is help researchers like yourself to get their ideas to have an impact. But obviously there are lots of challenges. The first challenge is how do you get the innovation to a point where you can commercialize this, and then the other one is once you have some product idea, how do you actually get it in the hands of customers, right? So there's that commercialization value of debt and the innovation value of debt. And about 10 or 15 years ago, when I was a grad student, if you had a great idea, you're pretty much by yourself. I mean, you went to the Office of Tech Transfer and they would help you the best they could. And they were kind of pretty much on your own. But a lot has changed in the last decade or so with a number of different initiatives at the university that sort of help ideas to sort of mature, to qualify them, and hopefully get them funded so that they can reach the intended customers or the patients. So in sources, lots of internal sources. There's resources through Michigan Medicine and also the NIH, which funds basic science research. Obviously, that is not the focus of today's talk. I would sort of classify that as intramural funding, meaning it's funding research that's inside the university. And there, in the last couple of years, there are a number of initiatives that have been started at the university, like I mentioned. MTRAC is one of them that Sarah and Michelle went over. They have a Kickstart program that's for very early stage ideas. If you've got an idea, they will give you a little bit of money to kind of try things out before you kind of apply for the big MTRAC program, which is funded by the state of Michigan and is open statewide for translational research. We also have a Coulter program that mainly focuses on medical devices that also will help you get to a commercial end. And then recently, I'm sure you guys have heard about the Franklin Innovation Initiative, which sort of spans the whole breadth, starting from very risky early stage ideas, with the intention of funding them so that, they can have the impact that the donors intend. And in this continuum, this is where the Michigan Biomedical Venture Fund fits. So about 4 years ago, the university realized that, while we have a lot of interesting research and we have translational funds and resources, the companies are still struggling to find capital to get to that end product. So the idea and the mission of the Michigan Biomedical Venture Fund is to sort of bridge that gap between internal that's to a stage where you can perform some basic product development, maybe hire talent to make the company more attractive for venture capital or other kinds of investment that will, further the cause of the company. So before we sort of talk about different funding, maybe it's important to sort of talk about, what is required for an idea to succeed. And I think a lot of first-time entrepreneurs or faculty or graduate students at the university kind of miss the point a little bit. So, whatever you're working on in your lab, it's an idea. You could have published it. The scientific merit of that idea or product or drug be extremely sound. There's a great need for it, but it takes a lot to get that from an idea into a product. So I see this as sort of a kernel of an idea. And you're not only going to require resources, you're going to require people, and it's going to take time. The first thing that a lot of times, entrepreneurs miss is you need a market. And oftentimes the market is really small or narrow, not to take or diminish the idea or the product, but it's probably not something that is going to attract a lot of investment, especially when there's no market. So often, we look at different ideas at Fast Forward or even through our run, and we find that, it's a great idea, but we ask them like, so who is this for? And they say, oh, this is for other labs around the world. And I was like, so how many labs like these are doing this kind of research? And they say like, maybe 5. That's not really a market. So for getting sort of venture capital or getting any kind of funds from other institutions, you need to have a large market. And then you have to have some way to sell it. So you have to be able to profit from it in some way, otherwise you can't support an organization. That sometimes is not quite clear. And the goal at Fast Forward and other institutes at the university is sort of educate founders on aspects like these. So you have all these things sorted out before you try to look for funding. And the next thing is you need a team. Obviously, the scientific credentials of folks at Michigan is never under question, but it takes a lot to get a product into market. Like I said, there's regulatory hurdles, there's business development, and there is running a company, hiring different people. There's different skill sets that you may not have, and that's something that's evaluated very, very closely, and we'll talk about it later in the presentation. And then I would say you need a CEO, and that's, it's kind of by itself. You might think it's part of the team, but it's kind of an essential component. You don't need one right straight off the bat because good CEOs are hard to come by, and they're not going to jump in with a very nascent idea. They're going to want to see some more stuff before they jump in. But it is kind of a critical thing. And, not always, but, if you're a scientific founder, definitely in the beginning, you will play that role, even if you may not have that title. At some point, though, either you kind of reach the limit of what is possible, or sometimes you grow into that role. We have seen that as well. Is that someone has to play the role of the CEO, and that is quite a different role from a technical or an operational role. Primarily the goal is of the CEO is really to be the face, the public face of the company. And mainly that has to do with an important thing that we are going to talk about today, which is funding. So any idea, however good it is, you may have the best team, maybe have the best market and the CEO, you're going to require money to move it forward, to replicate some of the experiments that you're doing, to build the product, to get it in the hands of customers and distributors. So today we're going to talk about funding. So before we talk about funding, I want to sort of make a distinction between the two types of funding. I guess one thing you need to also figure out I missed that point, is that we need to scale the business. But let's talk about funding real quick. So what most of you may be used to is what you may call grant funding. And in terms of venture capital speak or external speak, that's non-dilutive funding, and so that's one kind of funding, and the other kind is equity or dilutive funding. So what do those terms mean? So if you get a grant or you get some sort of what I call non-dilutive funding, if this is your stake in a company, let's say you have started the company, this is a stake in a company. Your stake in the company doesn't change. You get the money, which is great. And, you still own whatever percentage of the company. Maybe you split it 50-50, maybe you own 100%. Your stake doesn't change. But the moment you take some sort of equity investment from venture capital or some other investors, that is dilutive. So in exchange for a piece of your founder pie, they are going to give you money. So essentially you are selling a small piece of your pie to get access to that capital. And this is something that is sometimes lost on first-time founders, is that you may not always want to get dilutive or equity funding. And, we have people come to us and we say, yeah, we're sure, we'll give you 100,000, 150,000, but, we're going to take a small piece of the company. And are you prepared for that? So you're sort of giving up a little bit to get some money. And and we'll talk about it later and how this sort of pie changes over time. But in the beginning, you own all of it, and then over time it gets diluted, which is the meaning of equity or dilutive funding. And when I say grant funding, I mean all kinds of funding that is non-dilutive. So to kind of expand on that a little bit. So what are different types of non-dilutive funding? So there's definitely intramural funding that you may get from, say, MTRAC or Kickstart. Maybe your company is not formed, but you're still getting that funding that is coming in. And like I said before, NIH, SBISDRR, STTR funds are meant for small businesses, and they are also non-dilutive. There's definitely the MEDC at the state level. There's ETF funds that's also available at the Michigan, from the state of Michigan, that kicks in when you have a NIH, SBI, or STTR. And then there's definitely funding from local groups like Ann Arbor Spark. There's funding from the Washtenaw County, and there's myriads of different ways you can get funding. A popular way that a lot of our companies have got funding is also through foundations and patient groups. So if you're working on a disease, there are definitely patient groups that are looking to fund, especially in the orphan area. A lot of companies have got funding through that, and that tends to be completely non-dilutive because they really want to help you get your company moving forward. So that's something that you may want to look at first before you start looking for dilutive or equity funding. And then some other things that are not in the standard dilutive, non-dilutive funding are startup competitions, and there's a lot of them. The most famous one of them is Accelerate Michigan. That's every year, and that can be quite a substantial amount of capital. I think it can range from $300K to about $500K, depending on where you place. And some of our companies have been successful in getting that. Just recently, Spark concluded the Invest 360, which was also a startup competition. And then there's the Michigan Business Challenge. There's various competitions, not just here, but across the country that you are eligible for. And some I've marked in asterisk because, there is some component of that which goes into equity. We don't want to go into details about that, but in general, I would consider that non-dilutive funding. So while I'm on the topic of non-dilutive funding, there's other ways to also fund your company. And this is the traditional way that people fund businesses. Definitely bank loan is a way. If a bank will give you a loan that's non-dilutive, it's just a loan, you have to pay it back. Some founders have taken credit card debt, have taken reverse mortgages, or you can put money yourself, and that's non-dilutive, and you can own all of the pie. Obviously, if you're a founder, you're going to get some equity component, but I would consider that sort of non-dilutive because you own most of it. So, one thing that when we talk to first-time founders is, they ask, okay, so these are the different ways they can get non-dilutive funding, but what's the best type of non-dilutive funding? The best type of non-dilutive funding is that your business makes money. So if your business makes money and you are straight off the bat making a product that people will pay for, then you may not have to take a dime of anybody else's money from any external agency. So not all university startups are in that position, and we'll talk about that later. But it's something to consider that the quicker you can get to revenue, or you can make some type of sales, then that will fuel the next stage of growth for your business. So it's not a small thing to not consider, is to figure out some way that you can get some revenue. And then I want to spend a little bit of time on SBIR and STTR. The companies that we have in our portfolio, about 2/3 of them have received some sort of SBIR or STTR funds. So the website, feel free to go to the website. They have a number of tutorials on, how do you do that. And the money is fairly substantial, for a company that's starting out. If you've got a phase one, you can get anything between $50,000 or $250,000 for about 6 months or a year, depending on whether it's an SBI or STTR. And the phase two, that's about 750K. So when you add that up, you could get about $1 million in non-dilutive federal funding for your startup, which is pretty substantial money. And you can get a lot done with those funds for the first couple of years, at least in your startup. And one thing I want to mention is that if you do apply for the SBI or STTR, you have to apply for the Michigan ETF fund before you get the award notice. It's kind of a weird rule where you're not eligible for the ETF fund, which kicks in if you've got an SBIR after the fact. So it's a little bit backwards. I don't know why, but we've had companies that got a big SBR, STTR grant, and they did not apply at the ETF, so they sort of missed out on 125K of, I guess, free money for just getting an SBR, STTR. So I encourage you to go and look at that website. So the distinction between SBR and STTR is STTR, you need to collaborate with a university or research organization, which in most of your cases would be the university or the University of Michigan or whatever research institution you are at. And that's fairly easy, to figure out where your lab will be part of the research institute and the company will be doing the company stuff. But the SBIR is open to anybody, and both of these things are, powered by the Small Business Administration by the federal government. So that was the non-dilutive part. Let's jump into sort of the dilutive part, or equity funding, and then we can talk about the different kinds of equity funding. But what the point I wanted to make earlier was, dilutive funding means you are giving up some part of your company in exchange for capital. And most first-time CEOs, just think, I've got a company, I'm the CEO of a company, and there's just people walking, VCs are walking with bags of money, wanting to give it to me. Like, why shouldn't I get money? I've got this great idea, and that's how I get it funded. It's not quite as simple. That's one. And the second thing is, like I mentioned, is first-time CEOs or founders focus, very much on how much of the pie that they own, as opposed to growing that pie. And you may own a smaller chunk of the company eventually, in 5% in this case, but it's a far larger pie than basically not growing at all. So one of the reasons to get capital is to sort of achieve this rapid growth. So in the previous slide, if you recall, when I was talking about the different elements, is you're really trying to scale. You're trying to make this a bigger thing. And like I mentioned, the market's very important. If your market's really small, then you're not going to grow that rapidly, unless your customer is the U.S. government or something, which is going to pay a gazillion dollars for your product or your idea. So eventually what happens over time is that, you will keep taking equity and you will own smaller and smaller portion of the company, sort of ceding ownership to other sets of investors, and also control in terms of what happens to that company. And that's always a difficult thing for some CEOs. They're very married to the idea. This is their baby. They've worked on it for 15 or 20 years, and now they see other people sort of working on it or running away with it. So that is sort of the bargain that you make, and that's why I said that if your market's small, there are very, very good reasons not to take dilution. Maybe you can have an impact with the smaller market, and not to diminish anything that you're doing in terms of a technology or drug. It may just have a very small market, and you may not want to take dilutive capital. So speaking of equity funding, what are the different types of funding? And I would put them all under equity funding, though sometimes you may have heard some of these terms, and they use the word debt, which sounds like as if it's a loan, but it's really not a loan. It's a loan with conversion to equity in the future. So in the first column, when you start your company, like I said, the first place that people go to is their friends and family, maybe themselves, and maybe some fools who will fund the company to get them started. But usually when you have something going and you've figured out some of the elements of whether it can be a product. The first people to step in are known as angels. They're usually successful businessmen, or maybe they're retired people with a lot of experience who like to be with new founders and new ideas, and they have a little bit of capital to sort of act as mentors and guide you through the process, and they're hoping that they can get in early on some of these ideas and help you to the next stage, and they're willing to take that risk. So typically these angels really understand the field, not always, but in most cases, the angels, have either worked in the field or this arena, and they understand what they're doing, and they will put a small amount of money to get you off the ground. And then next comes, seed funds like us. Our goal is to, give a little bit of capital to some of these ideas and projects to get them to the next stage, which is really getting the big institutional or VC funds. And then in terms of, agreements, like I said, that it's not always equity straight off the bat. It's like, in our case, we give the teams or the companies money straight off. It could be 150,000 or 200,000. And we basically say, here's the money, why don't you go and do something with it? And then we'll worry about what that converts into equity. So it's basically future equity. So I would lump that under equity funding, even though it's technically shows up as debt. So convertible debt, convertible equity, pretty much the same thing. Safe notes is another version. It basically means simple agreement for future equity, which kind of explains itself. And then there's convertible notes as well, which have a little bit of interest, and they also convert into equity in the future. We can get into the more Q&A part in what these things mean if anybody's interested, but I think I just want to kind of put those terms out there because you may have heard of them. And then on the right-hand side is sort of more the traditional stuff that most of you may have heard, is buying actual stock in a company. So, there's a share price, you put in so much money and you get so many shares of the company. And this is all private, right? So these are not, publicly available shares, like you can go and buy Amazon or other shares, but these are private offerings, if you may call it. And then they could have, various rounds, A, B, C, D, till whatever, I guess you've got 26 letters, so you can have the Z rounds, but I haven't heard that yet. But that's the typical fashion where every round sort of builds on the previous one. They tend to be larger and larger. And definitely in the case of drug companies, Series B and Series C financing are not very uncommon. And then obviously either at that point, either the company gets acquired or you make so much progress, you decide to list and, have, get money from the public markets with the ticker symbol on the New York Stock Exchange or whatever, or the company goes bust. That happens a lot as well. So before I get into, what VCs are and, what they're looking for, maybe a sort of small aside may be helpful in just understanding where that fits, because, VCs are, or venture capital is a form of capital, and they have a different incentive. And I think understanding what the incentive is useful, because it's not just people walking with bags of money. They have a certain responsibility and a certain duty, and understanding that is helpful in kind of parsing their feedback or, their comments when you talk to them. So just real quick, in terms of all kinds of different investments that you can make, and some of you make some of these investments, venture capital is right on the top. The return has been spectacular, whatever time frame that you may look, and on the bottom is what stuff that mostly that you're used to, which is like investing in, in the stock market under an index fund or a real estate sort of investment. So venture capital obviously has performed really, really well, but the important thing is that, venture capital is willing to take some of this risk for superior returns. But it's also important to understand where venture capital or institutional investors get their money. Most of you may have some sort of pension fund or, retirement that's at the University of Michigan, or you've invested in some, some sort of, other money comes from those places. So, these pension funds or the Michigan endowment, they carve out a small portion of their endowment for what is known as venture capital. As you can see from this graph, a lot of it is in public markets. So, they can sell it and they can buy it back. And a small fraction of it goes to venture capital. So venture capital gets money from these pension funds, and their expectation is that, venture capital will deliver superior returns. And the reason why it's the smallest is because it's risky. You may not want to put all of that money in venture capital because, sometimes they do go bust. So it's just a way of, allocating their portfolio. And then some of that money flows into the startup. So, venture capital has to also pay back at some point, wherever they're getting their money from, like endowments, pension, family offices, so on and so forth. And, and these pension funds are paying your pensions or your 401ks as well. So, that's how the money sort of flows in the system. So the question is, why would you want to get venture capital? We talked about reasons why you may not want to do it, but if it's a massive opportunity, meaning the market is so big that you don't need to wait for it to sort of grow organically. So you need a massive infusion of capital to grow that. If you want fast growth, obviously, if you're $1 million to work with, you're going to make a lot more progress than you had maybe a tenth of that amount. There are also industries that are very new and disruptive that are going to change how things would do, and there are very risky ideas that need some funding. That venture capital is the only place that will take some of these ideas, and definitely a lot of the research at the University of Michigan is very cutting edge. They're working on sort of what is the future. So this sort of qualifies a lot for venture capital. It's rare that people are working on just sort of business ideas, which is producing more of something that's already there. And there are obviously ideas that require a lot of capital. Drug development is one of them. A lot of money goes into developing a drug before you know if it works or not. So those are the reasons why you may want to get venture capital. And we talked about sort of what VCs want. VCs have to return that money to somebody, so they are really looking for superior returns, and they are willing to take the risk for those higher returns. But that doesn't mean that they're going to go and fund pretty much anything. So here's a graph from CB Insights in terms of top main reason jobs fail is there's no market need, meaning you're building something for nobody, or you basically run out of cash, or you don't have the right team. So if you look at all these things, none of these top things, except for maybe outcompeted, have anything to do with your technology or your science. I'm trying to see where that is in this list. I don't see it really anywhere in this list where it's the science or technology that fails. Either you cannot get it in the hands of the customers without a business model, or basically there's just no market need. And there's other stuff that comes. So what investors are really looking for is they're trying to evaluate, what is the probability of any of these things happening, right? So if you raise any of these red flags, then it's very unlikely that you will raise capital. And this doesn't mean this is any sort of judgment on the technology or your market. It just means that this is not something that is venture backable. Maybe you need to find some other mechanism to fund that. So in terms of our process at the Michigan Biomedical Venture Fund, we sort of use a modified version of the business model canvas that has been sort of invented by Steve Blank and his colleagues. And we're looking at some of these aspects. This is just a way for us to sort of sort out, where, what are the pros and cons of the technology, in terms of, what would be major risks and so forth. So it's just sort of a whiteboard way for us to assess in a quick snapshot of, where the red flags are, where the risks are, as we sort of, evaluate the investment potential. But, the main thing that we are looking for is, what is your product, your drug, your device, and what is the market, right? So and trying to understand like how much of that product or market fit that you have. And like I mentioned, because we are in the capacity of helping startup companies at the University of Michigan, go out, sometimes you're willing to take some of that risk where, you have a great product, you have a kind of idea of a market, you're trying to find that fit. And we take that early risk of finding that product market fit to a certain extent, and help you sort of build that team, provided we think there's justification that you're going to be able to scale and attract the venture capital that's going to come in the future round. So that being said, I like John mentioned, I encourage you to use some resources at the university. Definitely, the education and training that's offered by Fast Forward is super helpful. I guess this webinar is part of that, but it helps having people who have done this before, mentors, to sort of avoid making the very basic elemental mistakes, and sort of adjust or pivot your product or idea so that you can get ready. And certainly at the Mission Biomedical, our job is to really provide that early capital to accelerate the commercialization, so that you can take some of these ideas and have them grow. So in terms of our mission, we are an evergreen fund. We hope to be around forever, funding some of these companies. So any return or any money that we make comes back to go and fund the next set of entrepreneurs or great ideas. So we've made about 10 investments through the fund. As you can see, it's pretty good of drugs, devices, therapeutics, and healthcare IT. Recently, we realized an exit through the sale of Parabricks, which was working in the genomic space, which was bought by NVIDIA. And our companies have been remarkably successful in getting some of this non-dilutive funding. So about 8.6 million has come from non-dilutive grants that have been raised by our companies after we made that investment, and they've raised quite a bit of equity as well. So our goal is really to help you get to that next stage, so that you can go and raise these large amounts of capital from institutional and venture capital investors. So our role is dual, where we evaluate your company, but we are also in a capacity of helping you and guiding those companies to do the right things to be able to attract capital. So we've invested about 1.6 million so far, and so far all the companies that we've invested in are alive, and we've got one exit. We hope to make a couple more investments this year, and then I'm happy to take questions about it at the end. But that's sort of what we do, and this was our exit. So it's an interesting story. These were two computer science students who had just graduated, and instead of going to Amazon and getting lucrative computer science jobs, decided to stay back and build this company, and we funded them. They were first-time CEOs. Not many people would fund something that was that risky, but we do believe that this is going to be a big area of growth, and we helped them out. They were able to attract other capital from other local investors as well. And about 2 years after they sort of got money from us, they were bought by NVIDIA. So they've created jobs, created wealth, and it's a good example of a successful company that's come out of Michigan through the fund. And then in terms of resources, I mean, there's tons of resources that weren't available, maybe a decade ago. There's definitely Fast Forward that you should reach out to first if you're in the med school or working on a life science project. There are a number of mentors and resources, Office of Tech Transfer. You should be happy to seek them out as well. And then there's definitely other courses and other resources at the College of Engineering Center for Entrepreneurship at Ross. And then, I'd really encourage you to check out Ann Arbor Spark, the MEDC and the SBA websites as well. Ann Arbor Spark has a lot of events that, talk about some of these aspects. They bring in other founders and inventors, and they have interesting talks as well in collaboration with Mish Bio that, may be helpful for you to attend some of these things. So, there's a ton of resources out there just to get, this on your radar. And obviously, if you've got any questions, feel free to reach out to me or, contact John or Sam, and, they'll put you in touch. So I'll stop there for any questions that people may have. So thank you. John?
Yeah, thank you, Harak. So yeah, let's take questions. What questions do you have? Feel free. We're a small group here, so if you'd like to unmute yourself and ask Harak directly, feel free to do so.
Harak, this is Brad. I'll start off. I know that each deal is very much an individual thing, but is there a general sort of reason why companies that come to you that you decide not to fund, what's the most common reason for you not deciding to pass on that particular deal?
The most common reason is that it's a little bit early for us, and I think that a lot of the companies that we pass on, the very early stage, we don't even bring them to a board, is that they probably need to go back and utilize some of the resources that are available, like I mentioned, Kickstart, MTrack, Coulter, and it sounds, not in my interest, but, we try to push people away from getting money from us because it's dilutive. We want them to use all the possible non-dilutive resources that they can. That's one reason. And the second reason is that once you form a company, you're kind of outside the university. So you're eligible for some resources, but not all. So there are, pros and cons to forming a company too early, right? And, like I mentioned, one of the things, leaving that aside, one of the aspects that we say no to companies is that, it's not, the business model is not very clear. It's like, how are you going to make this thing and who's going to buy it and why? Like, what's the channel? What's the regulatory pathway? So some of those things are a factor. And then the main factor is just not quite the right team. We don't expect that, your faculty are going to have, everything, a CEO and CTO and CFO all lined up. But, we want to see some balance in your team where there's a good mix of, maybe a scientific founder, but then you also have successfully been able to attract someone who has done this before, maybe has some business development expertise and, has a network, because you're going to require that network to reach out to funders and other people. So the companies that we turn down are usually in that category. I mean, it's very rare that we turn down companies because we don't think that it's going to, the product's going to work. I think the product, the science is always good, but, the team's quite not there, or the market's not large enough. Because like I said, our goal is not to fund you so you can go and fail, when you go to raise institutional capital. We'd say no to you because we just don't think that any venture capital would invest in you the way we see it. So, we often say no, sort of preempting that failure further down the road.
Got it. Thank you.
Any additional questions for Harak? Okay. Well, then we can go ahead and wrap up. Thank you again, Harak, for joining us today. Very informative. Appreciate your time and expertise. And thank you again to everybody who's on the call that joined us this afternoon. And don't forget, we have one more webinar scheduled for September 2nd, and we hope to see you there.